Good evening. It's a pleasure to have all of you here joining us for the session of financial freedom. It seems like something that we all want to attain, but till date, only 1% of the population of the world has been able to attain the same. I would like to start with a very famous quote by a very famous author, businessman, and the financial expert, Robert Kiyosaki. Financial freedom is freedom from fear. And I'm quite sure our expert panel members are going to give you that kind of freedom or the knowledge to become that fearsome person to take that risk and attain the financial freedom. To start with, I will introduce Mr. Biren Parekh. Mr. Biren Parekh is somebody who had a great and august career. The gentleman has been an agile leader with a global footprint in steering complex digital transformations across retail and corporate banking sectors. He has a decades-long immersion in project management, encapsulating his experience in a book called Supercharge Your Project Management Skills. Additionally, he has been acknowledged as one of the top 25 thought leaders in project management, fintech, and edtech. It is a pleasure to have Mr. Parekh along with us as he is dedicated to empowering startups and professionals as angel investors and mentors. Right now, he is serving as a director to CRISIL. It's a pleasure to have you, Mr. Biren Parekh.
Thank you.
The next esteemed speaker is Dr. Prafulla Ranjan. Dr. Prafulla Ranjan has more than 35 years of experience working with banking giants like ICICI, IndusInd, Jharkhand State Cooperative Bank, and right now he is the MD and CEO of Haryana State Cooperative Apex Bank. He has been an author of few books. He's been a director of a lot of educational institutions, and he's somebody who started a lot of strategic alliances into the public and the private banking sector. It's a pleasure to have you along with us, Dr. Prafulla, sir.
Thank you, Vivek.
Mr. Rakesh Kumar. Mr. Rakesh Kumar is having an illustrious career of 26 years of experience in strategic leadership, banking operations, and business development. He has honed his skills in devising and validating operational strategies to maximize profitability and revenue generation. Currently, Mr. Kumar is state head at IndusInd Bank Limited, spearheading banking operations including retail liability, credit sanctions, business development, and key relationship building. It's a pleasure to have you among us, Kumar sir.
Yes, thank you, Mr. Bray.
The next speaker whom I'm having a pleasure to introduce is Mr. Santosh Chandra. Mr. Santosh Chandra has more than 22 years of experience specializing in B2B and B2C channels. He has been working with the channels as a national channel head at Jana Bank. After that, he's been looking as an EGM and regional manager for business performance at the Muthoot Group. He's somebody who is a corporate mentor, a trainer, and a subject matter specialist, along with specializing in BFSI sector and IT sector skills in developing new channels and new integrations for both the platforms and both the domains. It's a pleasure to have you here, Mr. Santosh Chandra.
Thank you, Mr. Vivek Joshi. Thank you.
Thank you. It's a pleasure to have all of you, our august listeners, our august audiences, to have you here who make this event much more precious and valuable for us. I hope we are going to give you some kind of insight into financial freedom. To start with, I will be asking my esteemed panelists a very basic question. Understanding of financial freedom is something that we could have the financial independence, something that we all would like to have, but we could not have. What are the basic reasons behind not being able to get this financial performance, this financial freedom, this financial independence? So our audiences can get acquainted with what are the pitfalls, what are the things they should not do in order to make sure that they're complying with the right path to move along or tread along the financial independence.
So good morning. I think you have given the discussion a very good kickstart. See, the basic, we'll talk about the basics. See, most of us, including me, initially, we never understood the crux of financial freedom. Because the early you understand, the better it is. So my first take or first advice to the next generation, see, I am at the verge of retirement. I am now 57, 58. But the next generation who are starting their career, the first take is start early. The early you start, the better it is. And you have a lot of time to plan your your investment plan, your financial freedom. Number one. So you need to understand it at the start of your career. Then you need to make your financial goals very clear. Down the line, what do you want? You want in 5 years, you want a big car. In 10 years, you want a house. In say 20 years, you need funds for your sons or daughters' marriage. So your goals should be very clear. Once you make your financial goals, see this you have to do initially only. So you must know what exactly you need to achieve down the line. Then the next step is your budgeting. You need to budget. See, I'm talking about. No, I'm not talking about the people who are filthy rich. We are most of us are from middle class family or upper middle class family. Our incomes are limited, so you need to budget your expenses and your savings, and then invest in the right investment options, which we'll be talking about later on, how to invest on those, and then see your progress. So budgeting, and most important is tracking your expenses. See, expenses can be unlimited. You cannot control, or you have got everybody has got immense and needs and wants. Everybody wants to live leisurely partners. You need to budget and see how much you can expend and how much you have to save. So you have to track your expenses. Most important point here, Vivek.
Prafula sir, there is something
Yeah,
that
let me finish. This is most important. See, most of us do a mistake of having a single income. If we have multiple income, if we do something like investing in shares, investing in mutual fund, investing in LIC, investing in property, if we invest properly, your multiple income will make you success. So these are some important basic thing which I wanted to kickstart, which will give you financial freedom in future. Rest we'll talk once we go.
Prafula sir, am I audible to you?
Yes.
Yeah, you have given us a great insight about what the financial freedom and what is needed to be done. But my next question will be from Mr. Parekh. Mr. Parekh, there is a question that is consistently being asked, like what exactly is an ideal portfolio? Because portfolios are being taxed, even short term, long term, depending from the government to government, and then there is something called inflation, and then the differential rates of interest which are being offered. So for somebody who is coming from a middle class family and is a salaried employee, how exactly or what is going to be the weight of the different securities within the portfolio that you would suggest, sir?
Sure, very good question. Vivek. So as I think earlier mentioned that there has to be a multiple avenue of incomes that needs to be built. And as a part of that, there has to be some kind of investment which one has to do, so that now there is a sort of a constant or continuous income which keeps coming every month or every period or every quarter or every year, right? So first of all, one has to understand the person's appetite. Okay, risk appetite, I say that, is that how much risk you are able to take. If you are a good risk taker in terms of maybe you are okay with losing some money, then maybe that will be a different strategy. And depending on if you are very conservative, that you don't want to lose any capital, then the strategy will be different. So if you are having a high risk appetite, then you can go for maybe your equity, obviously with careful advice and whatever strategic advice from experts. And if you are, say, for example, less risk taker, then you can go for mutual fund. So first of all, in your overall portfolio, there are various assets where you can invest or where you can get the benefit in a long term. So real estate is one, but obviously the real estate takes a huge amount of money, and early in your career you might not be able to invest that much. So that is one thing. Second is about term deposit or fixed deposit. Again, that gives a very safe return, but that will take some time and it is not going to give a good return. It is going to be a very minuscule return. third, as I said, mutual fund or maybe equity. So mutual fund is a safe, but it is a, in long term only you'll get some return. Equity might give you a good return, but that will be a risk, a kind of a risky kind of a thing. And obviously, then there are government bonds and securities which can give you some kind of a safety net. I mean, but again, that is going to take time. So, in my opinion, if you are early in your career, focus should be more on the equity, maybe 30, 35%, 40% can be equity. Next can be mutual fund, maybe around 20, 25%. And maybe remaining 25, out of remaining whatever 30, 35%, you can maybe put something into for fixed deposit and something into government bonds and securities. And after whatever your income has steadily risen, then you can look at maybe investing into real estate. Again, it depends. If you are not going to be staying at one place, then you can you need not invest in real estate, and you can maybe look at maybe doing it at a later stage of life. So these are the some high level suggestion which I have, Vivek.
That is great, sir. I would like to ask something about crowdfunding for the startups, but I think we'll leave it for the later. My next question will be from Mr. Rakesh Kumar. Sir, you have been at the forefront for credit, and might have seen a lot of people having a good credit rating to start with, having good FICO score and a good CIBIL score to start with, and they have been easily given the loan by the banks. But due to dynamism of the job market, maybe dynamism of the age and the family life stage that they enter, and suddenly you find them that they are having debt concerns, and they fail to pay, though they have been very disciplined. But yes, because of the circumstances, maybe because of changing family, or maybe some kind of a medical emergency, these things just happen. So, what are your advice? What are the steps that you would suggest to these kind of people, or the people who are taking large amount of loan because they have the capacity to pay, but then who do not know, or even banks do not know, that they may be unable to pay later on? So, is there something to help them to avoid that debt trap at any stage of time? Maybe when you are not even having the loss exposure or risk exposure being identified, but still, how could you manage and how could you strategize something so you do not fall into debt trap even because of the situation or the events beyond your control? So I would like if you can share and shed some light on them, sir.
Thanks, Vivek. Right, I think that's a very good question. Right, I dealt credit, and with my own experience, I can share in early career of mine. Right. So first of all, credit is a very very disciplined thing. Right. So if we talk about the financial planning, I think debt and credit is one part that one should be very careful about. Right. When we are sharing, there is nothing to be afraid of. And now, since the system is so much uh, automated, so if you talk about all those things, whether it is CIBIL score or you talk about the GST return, I think everything is interlinked somewhere, right? So now with a, I mean, just click of the button, I think all the cash flow would be coming out onto that. So whether it is for individual or it is for the business, the basic requirement of the credit is the same. Whether we are in a position to handle the cash flow or not, and whether we are taking some bigger side which is not going to meet out the future cash flow or not. So if those two things are planned properly, and again I'm just connecting it with the managing of financial freedom only, right? So if we can, I mean, connect with these two dots, I think taking a credit, paying it during those times would be very easily. Now the second thing, when we are taking the credit, then one should think that how we are going to retire that loan. Because I think that too is, when we say on the financial planning, every money that is being saved is the money earned. So that's a basic philosophy of it. So say if some individual during the early career of his is opting for a housing loan, right? So housing loan is going to give two benefits. One, the capital enhancement that is going to happen. If he is creating an asset class into, you talk about the residential one, then I think the income in terms of rental income that will be coming to that person, that is the second. Third, in the early period of it, there would not be huge amount surpluses with that person. So it is a type of SIP which he is buying in for considering his future income into account. But when he is doing that, I think one, the repayment should be very clear. And whatever the surpluses that he is generating, whether it is through the pay hike or it is through the bonuses, the person should always be very careful that that credit should not go for the entire period, but it should be paid off before the time. If it does it, I think then the real asset value would be coming in. Because if he carries the home loan for the entire 20-25 years period, then ultimately the cost of acquiring that property would be very high. So the capital gain would not be much. So this is one. If you talk about the business also, on the business side also, I mean everything is depends on to the cash flow. So if you talk about the and that is how perhaps the government of India has somewhere connected this GST return. And the process is so seamless that now I think any businesses, right? It could be a proprietorship business as well, right? Any businesses, I think GST return is being taken, and with the tab, I think whatever the performances are there, that is coming in, and basis that the limit what is being set in, perhaps it is taking one day. In certain banks, it is taking few hours that credit is being provided. Leave aside. The third part is, and again, the basic philosophy behind is the cash flow. The third is, the bank has gone ahead by providing the credit within maybe half an hour. Within half an hour, right? And there are pre-approved loan also, right? Because whatever the transaction pattern is there, basis that, I think pre-approved loan is already sanctioned, and with the customer saying yes, and the entire credit line is being given. Now, when we say this, there are certain, I'm not saying that's a good credit or bad credit, but not so good credit. So say, for instance, it's a credit card. So if credit discipline is there, then credit card is a very good thing. But taking a credit card loan for paying another debt, I think that's a very, very detrimental thing, right? And it will be somewhere, I mean, destroying the entire credit line. So in nutshell, if you take all those two, three pointers over here, if we are going to maintain the discipline, if we are having a control onto our cash flows, right? I think taking a credit, right, acquiring an asset is not much of a problem, and ultimately in future and maybe 10 years ahead, maybe 15 years ahead, it is going to give a humongous gain. At the same time, there are certain tax rebate also which government is providing, right? That too is adding the value onto that. So that's my thought onto that. Thank you.
I think Rakesh sir has very elaborately given the way. I think to sum it up, financial discipline means your revenue generation and your expenses. If you can control them, there will be no issue in the life. Be it a business, be it your salary class. So your revenue, whatever you are earning and whatever you are spending, if you control them, I think there will be no issues, and you will never be in the debt trap. So this is the crux of the talk which Rakesh sir has given now.
Thanks to Rakesh and Prafula sir. There is another point that I would like to add, because I have seen people in India, they are, very much to their physical property, or especially to their home where they have been living, and they do not want to do away with it. But when you look at the Western world, what they do, they will, they have a mortgage, they will do away with that property, and they will shift to some other property, thereby making some money and also paying the mortgages. So it seems an Indian situation, in Indian culture, this also makes little bit challenging for us to manage. Santosh sir, is there anything that you would like to add? Am I audible to you, Santosh sir?
Am I audible now?
Yes, you are very much audible,
Okay.
sir.
Mostly, I think basic points were covered by Prafula sir, Rakesh sir, and Parik sir. The basic thing, as a CFP, I am a certified financial planner from FPSB board. There are two things which are basically taught for any individual, that how we can make a solid foundation of the financial security. So financial freedom is a stability which an individual or an entity should take care of it to bear the unexpected losses, or maybe the risk. So, and financial independence. I think Vivek sir, you told that there should be a financial independence as well. So, financial independence is a part of financial freedom, where it shows that how to generate a regular income to become an individual financially freedom from any kind of expenses. So I would say that any individual who keeps a mindset clear, simply simple investment, that would create a financial freedom in longer term. Only required is the discipline and the patience. So which I personally feel that out of my experience, that there are a lot of upwards and downwards in financial stability, as we are salaried individual. So I would suggest any individual who is working for a company, or any individual who is a startup, or managing a funds from any, maybe a crowdfunding, or maybe any kind of a fundraising method, they should at least have a patience and work towards a simple method. See, another rule which we follow is, I think most of us knows about 50-30-20 rule. So that I would recommend to stick to that rule. That is 50% of your money, it's towards the needs of an individual. 30% should be a want of the individual, and 20% towards the saving. So needs and want is actually most of individual gets confused in needs and want and saving. So the saving category would also include the money which we will need to realize a future goal. So saving is kind of a future goal which we realize. Want is basically which is in the present. Needs is the basically which is ongoing. So that is the shortest thing which any individual can understand, not to get confused. So saving, which I say, that is person has to have the long-term financial goal, which will enable them to retire and get a peaceful life. Wants is basically which the people desire of, and needs is basically which is the regular needs or ongoing needs which is there. So I wanted to add this, that is basically for the early starter or early salaried individuals who wants to do a financial planning. Then this would be the best rule of saving and to get a financial freedom. That is in short, Vivek sir. I hope I'm audible.
You are
Yeah,
very
yeah.
much audible, sir. You are very much audible, sir. Thank you. We have been talking about cash flows. We have been talking about disposable and income that we could dispense with. It brings me to another important fact, which we call insurance and insurance contract and the insurance policies. And somehow this question just came to my mind. For somebody who is into their early 40s, early 50s, what kind of insurance contracts could help them to attain this financial freedom? Or are there any insurance policies which they can really look at? And maybe a term plan, but term plan is more to cover the uncertainty, but maybe some kind of investment options built into the insurance. I somehow feel it is hard to find. Maybe there has to be something, maybe the Mediclaim or some kind of plans that we could suggest. Or should we completely refrain, or just for the sake of security we should keep on inputting money into the insurance plans? What is the suggestion of the esteemed panel members? I would like to know.
Vivek sir,
Vivek sir, let me give just one input here.
okay
See,
sir.
so this is my personal experience, and in fact, I'm talking to all the people who join under me. See, first thing which I suggest to youngsters who have just started their career, please buy a term plan of a very huge amount, maybe 1 CR, 2 CR. At the early age, 22, 23, 25, you will get it at a very low cost and buy it for 100 years, because the cost will be, the longer is the period, smaller is the premium. And once you buy this term plan at a very, so 4,000, 5,000 rupees, you'll get a term plan of 1 CR. So buy that, and then you have very peace of mind. If by any chance, if something happens to you,
Prafulla sir, are we audible to you? Prafulla sir.
yes,
Sir, please
hello,
go on. Yes, sir. Yes, sir.
yes, my voice is not going.
No, no,
Yeah.
sir, your voice is coming.
So that's what I'm saying. Or all the young people who are starting their career, please buy a term plan of 1 CR or 2 CR at a very small premium, maybe up to 100 years. So that is the first thing you should do in insurance. The rest others can add.
Santosh
Can
sir
I?
seems like, yeah, please, sir, Biren, sir, please go ahead, sir.
Can I?
Yes, sir,
Can
please,
I?
please, please. Yes, sir, please
So,
continue,
so
sir.
Please go
I
ahead, sir.
think, Professor, I think that that's a very, very right advice, because we too have felt in our career when we started off, nobody suggested on the term plan. So perhaps for the insurance, that is the first thing which is a must. And earlier it's a better for us, right, in terms of premium and everything, and of course the risk coverage. Now, when we say this, right, so of course it all depends on the risk appetite, right? So if there is a momentum market which is going on, you might be saying that how the index is moving and so on, Sensex is moving and all, right? So into those periods, right, even if someone is going for the ULIP policy, right? So I think returns are there and some amount of coverage too is there, right? The third thing which has come to it, and let's agree to this, that in India, insurance is still under penetrated, right? The third thing which is there are hosts of schemes that came in, right? Which would be providing, right, a retirement type of guaranteed return, right? And if someone is getting, say, I was just going through one of the policies, details of one of the policies of by one of the manufacturer, right? So giving a return of 6.99%, just hear it right, 6.99% for a person who is having an age of 40, coverage going up till 85 years, right? That too tax free, right? I think that's a very good return that the person is getting. At the same time, even at that age of 85 years, right, that person is fully covered so far as insurance risk is concerned. And if something bad happens, I think their dependents would be getting a huge amount of it. So those returns are guaranteed. Those are taking care of interest rate ups and downs, because 6.99% for a period of maybe 40-45 years, that's a very good return. Nobody can claim that maybe 5 years ahead from here, what would be the saving rate? What would be the fixed deposit rate? And moreover, those fixed deposit rate, that too is coming at a discounted value in terms of someone has to pay the income tax onto that, right? So to that extent, I think perhaps that is one of the reason that the graph of the insurance in India is going up, and more manufacturers are coming in India, right? And those are profitable as well. So policies are there, guaranteed returns are there. Those returns are for the longer term period. It is giving us the tax-free return for a long period. It is giving us the coverage so far as our risk too is concerned. And at the end of that, if some eventuality happens, I think the money is going back to the nominees as well. So it's a good investment class so far as my view is concerned. Thank you.
That's great. That's great. Parekh, sir, any views from your side, sir?
Yeah, so I think Dr. Prafula and Rakesh Kumar has well articulated. But I just like to add one point. So this term insurance definitely is a good, but that doesn't give you means when you are planning your financial freedom, it doesn't give you that freedom. Okay, it is more for your dependents. Okay, that in your absence something uneventual happens, then now it is to cover your dependents. You are doing this, so that is absolutely necessary. But one thing which is most required and should be done on the priority basis is Mediclaim, because having Mediclaim, I mean, without Mediclaim, it will be really difficult not to face today's medical expenses, which is like soaring like anything. And not only the hospital expenses, but even the medicine expenses are also not good. So that is very first good amount of coverage one should take, so that now in case if he or his family are having some issue with the health, then they are covered and they should not be left with a debt or maybe whatever. Okay, so that is one thing. And second is obviously home insurance. If you have purchased home, that is also preferred, particularly when you are living in a calamity area. Okay, then you have to see that you are covering the respective calamity. So if you are living in the coastal area, then maybe tsunami or hurricane kind of a calamity. If you are living in the earthquake prone zone, then you have to ensure that your earthquake cover is also there. So I mean, all those relative insurance for your home or property is very much required. So these two things, I mean, will give you a benefit in case of your personal financial freedom, and not only the dependents when you are not around. So that is my view. Thank you.
Vivek
Thank you.
sir, there,
Yes, sir.
Vivek sir, there's one aspect in insurance we are talking about. See, there's a great debate. It's going on since long whether insurance, maybe I'm talking about life insurance, is a perfect investment option or a social security measure. So this question is, in fact, a big point of debate, and I think still there is no solution to it. See, whether it is an investment or it is a social security. So we need to take a call on this. And maybe if anybody can add light to this, I'll be really happy.
Sir, this brings me to, most critical uh, point. It's almost like an incident that I was discussing with Rajdeep, before we started. My father earlier had a Baleno which he bought for some 4 lakh 75, 78,000 rupees. And 2010 end or maybe 2011 start, I bought an i10 for him, and it was costing the same price. And my father told me that you sold my bigger car for a smaller car and you replaced me with this. You gave me something which is a smaller car. So you are demoting me. So, I somehow feel that, how much you try to plan, how much you try to move ahead, maybe the inflation, the effect of the taxes, maybe the cost of keep on investing into these, investment options, investment avenues, or as we call them, the instruments itself become too much that the amount which is actually going to stand out as the financial security money is either going to be, too minuscule, or the amount that which we should target for is not correct. So is there any amount, or is there any way to calculate that exact amount which you need to have as per your stage of life, or maybe as per your age, which you need to have in order to have the financial security, maybe once you retire at the age of 65 or 70? Because I still know people who are working at the age of 70, and they are very well to do off, but they say, no, it is not sufficient for my life, because my children, they have a very different lifestyle, they could not support me, and children are already doing very good, but children are not having enough money because they have the loan liabilities, they have, they have their own mortgages to pay. So these people, even at the age of 70, are working, and they say that we could not rely upon our children. So what exactly is that one amount, or what exactly is that way to calculate that amount? So maybe once you are 25, 30, 35, or 40, you know that, okay, this is my targeted amount of saving, so I am going to have the financial freedom, and then we could devise the way forward.
So I
I would
like,
appreciate
yeah, yeah. So
it
I,
from
yeah, so I like to mention 2 points over here. That your point is very valid and very, I think, debatable also. So one is that, see, one has to remember the golden rule, that your passive income should be greater than your active income. Okay, that should be your objective. That should be your golden rule. So when I say that active income is whereby you are working on a daily basis and you are getting some amount of money, whether it's a business or whether it's a job or whatever freelancing, right? And passive income is whereby you are deriving your money by not working it. So, like for example, FD, or maybe investment into equity or mutual fund or government securities, right? So money coming from those kind of sources where you don't have to work, but they come because of your investment or whatever, no, putting the money somewhere, that is passive income. So you have to see that your passive income is greater than active income. That should be your ultimate objective. Okay, so for example, if you are earning 1 lakh, then you should see that I am getting at least 1 lakh 1,000, whatever the same duration. Okay, if you are able to manage that, then that will solve your problem. Okay, because when you retire, at least you will have that much money coming from the various investment class or asset class which you've done. So that is one thing. Okay, one rule. Second rule, they say that now what is the amount of money which is required when you retire? So they say that depending on the amount of your annual expense. Okay, so I think even Santosh can, being a financial planner, will can comment on this. But they say that depending on your annual expenses, okay, you need to see that you are able to have a corpus 25 times of that. Okay, so say for example, every month you are having say 10,000 as your expense, then you should have a corpus of 10,000 a month. So there is 1,20,000 as your expense every year. Then you just multiply that with the 25, and that should be a corpus. Now, at least when you retire, so that now you are able to uh, live at least the same decent life. You are able to meet the same expenses. Yes, there is the inflation which needs to be added, but that should be your rule. Yeah.
Sir,
Viren sir, you missed
hello, sir.
a very pertinent income source, which is rental income, passive income, rental income, which I think I am enjoying.
So Vivek sir,
Professor,
there are
not
a lot of
everybody is as lucky as you. Santosh, sir, just give me a minute. Just give me a minute. I would like to add another dimension to the problem, because once we said that 50-30-20 rule, so once 20% is only going into the investments, how exactly we could, plan to have that higher passive income in comparison to the active income? Not everybody is, born rich like Prafulla, sir. So we all, are moving towards, creating something called wealth. And with the 20% saving, even let us assume that even if you are saving 40% of the money, and then you have a ailing parents to take care of, you have a children's education to look at. Because I'm very scared of one thing, which personally I will quote, because if one of my children wants to become a doctor as on this date, and they say that I would like to be a doctor, and unfortunately they do not get admission into a good government college, I may have to look for a private college, and getting them admitted into private college is a 3 crore affair. So if I invest that money and then I wait for 5 years for maybe my son or daughter to become a doctor, and I'm talking about today, I'm not talking about the actual time when they are going to, get admitted. It may be 5 crores by that time. So how exactly I will be able to manage my corpus? This is something that really, is a concern, maybe for me and even for the others also. So how could we address that?
Yes, sir. Yes, sir. See, first thing which I wanted to, enlighten the audience about, as you said that there is a saving 20% and we wanted to make a wealth, and Viren Parekh sir has clearly said that 20% should be a corpus higher than the saving. See, most of us also were confused between saving and the insurance or maybe the need. So the insurance basically is a fixed asset. When we talk about the cash flows on PNL, when we see in the PNL, it should be in the asset side. So when we say the asset side, so that is when uh, how it is. Like most of us, they just say that okay, invest in term plan for a longer time, and then why? So why they say that, and why not? Why not the equity part? Why not this thing? So simple thing is that wealth, we cannot, wealth, insurance is a part of another money making wealth, money making, what you call financial freedom, is a part of wealth, which we have to make a corpus. So wealth is not a short term or something that, as you given an example, that we wanted to save and for a future and then wanted to make a wealth. There are various factors involved in it. The first point is that we should not get confused between the saving and the need. So insurance is a need where every individual, whether it is a health or whether it is a non-life or whether it's a life, so that is a need of a person which should protect a dependent. As Parik sir and Prafula sir has clearly told that that there is a protection towards the dependent. Second thing is how to make a wealth. As Parekh sir has clearly told that we have to make a corpus. So most of them say that okay, you have to, most of the financial planner or most of the educated person, they say that okay, you make a corpus. So how to make a corpus? So there is a lot of study into it. When we go through the Form 16 or maybe the PLN of any individual asset side or liability side, when we see the cash flows, so insurance, we take insurance, that becomes a liability because we are paying a monthly, on a monthly basis in advance. I mean, it's a prepaid expenses towards the insurance, and we are increasing the cash value on a regular basis, on a periodical basis, on a cumulative basis. Let's say when we paid for a 1 year, we have prepaid it. We have prepaid expense, that becomes a current liability. And then when after 1 year, we have made a cash value out of it, or maybe bonus, that becomes an asset to us. So hope I'm clear on it. So that is next thing is, once we make a long-term investment, let's say term plan, so we should understand why we most focus, and most of the experienced officials like Prafula sir and Parekh sir and Rakesh sir and Vivek sir has clearly pointed out the term insurance. Why do we do it? So every year we make a asset. So that comes into the fixed asset point. So every individual who is new to this insurance business, not to only sell it, but at least make a educative point, to make educative awareness to the individual why we should invest in term plan. So that is one. Ki we are making an asset every year, asset value every year. Mean we are creating a wealth every year and on year. So that is one logic. Second logic, we work on creating a corpus. There are various ways on it. Various as per the government or the tax laws, we have to invest accordingly to make a salaried person to get a more of the income and reduce the tax liability. So that is also points to be considered, because we have to make ensure as a financial planner or a financial expert, we have to make sure that individual saves much, so that to ensure the tax liability is less, and they should get a more protection and more cash values of asset towards the protection of their own kins, loved ones and dependents. So that is number two. Number three, since it is, let's say for example 1 lakh, so 25 lakhs or 25%, maybe a 20% or maybe a 20% extra to be a corpus to be handled towards the retirement. So retirement planning, term insurance, and you can say the equity part depends on the age we are now. So that is, let's say for as early age, then equity part should be more than 70%, and 10% should be the term plan insurance, and 20% should be a kind of a health insurance plan where they have to cover the emergency part. So this is third one. Fourth one, which I wanted to highlight is that this is once it what you call mm, for an example, why is life insurance is basically an asset. So
So,
that covers a business because that covers a asset in case of unexpected event, loss, natural damages, maybe a fire or theft or something. So let's say one example, Vivek sir has told he has purchased a Baleno and the insurance he has paid this thing. So depending on the insurance, what is the insurance covered? So how do we calculate it? Why do in a company or a car has the 2 years of insurance coverage, or maybe a zero debt comprehensive coverage till 5 years? Because the quality of, or the bandwidth, or you can say the product long lasting tenure of any product or any of the equipment or items which is fixed into the car has a life maximum life of till 5 years. So that is where the insurance they do the actuarial part, and then they decide that insurance, this much insurance coverage would be given, and this percentage would be the premium thing. So how do we do it? We also calculate a premium against a value, and we calculate the feature value would be what kind of a feature value would be there, and then we the premium will be decided on a present value. So that is one part. So that is the reason the any person gets any kind of a damage or uneven death, or maybe a kind of any disability. So depending on the percentage wise, that depends on the car value, the insurance premium will be decided. So that is what I wanted to focus on, Vivek sir. If
Vivek sir,
any,
Thank you.
Vivek
Yes, sir.
sir,
Yes, sir.
to give your pointed answer, making 3 CR in a day is out of question. Now, how do we do it? So there is a strategy called dollar cost averaging.
yes sir, yes
See,
sir, very nice.
you need to go to equity market and invest every month a certain amount for a longer period. Most often than not, you will be coming out with a very good return. Second one, see, there are some stocks where you know there is a forecast that it will grow in future. So buy and hold. I'll give you an example of my previous organization where Rakesh sir is working. I got 30,000 of ESOP at 40 rupees. Now the prices are 1500 plus. Just think how much return I would have got. Of course, I sold them halfway when it was 500, 600. But still, so to make the amount which you are talking about, 3 CR, you have to plan early, invest regularly, invest and hold it for the better return, the best return. So I think I can sum up like this.
Sir, Prafula sir, this brings me to another very interesting point, because we talk about the investment, but then there are a lot of investment strategies, because there's somebody who says value investing, somebody says timing the market, somebody says quality investing. You just talked about buy and hold, and I have a very important, interesting statistics also, because when we talk about the mutual funds, over the last 15 years, only very close to 8% of the mutual funds have been able to outperform the market movement. And when we look at even at the retail investors, lot of retail investors have lost money rather than making money. And the general tendency says that you need to have a bigger chunk in order to, or you should have that capacity of keeping that money into that corpus or into that portfolio for a longer time. So what kind of what kind of investment strategy you would suggest to our audiences? What kind of strategy we need to have? What kind of investing strategy we should follow? Or what kind of instruments, either the mutual fund or the index fund, or maybe directly investing into the stock market, would you advise for our listeners?
See, here I'll tell you, depending on your risk profile, you need to take a call. So there are people who are very aggressive. So they will certainly put their most of their money into uh, equity, and they play very heavily. There are some moderate investors. They play safe. They maybe 50% they will put into equity and 50% into the other asset. And there are some conservative investors who do not go into this equity market at all. See, uh, there are various strategies followed by various people. What two I talked about. Other is you need income. If you want, so there is an income investing strategy where you invest in companies who gives you very good dividend. So you are getting a very good return out of it. And in fact, there are some blue chip company, they give you a very good income. And the most important sector is your real estate. Real estate, certainly you'll get a very good value in investment. Then there's other strategies called growth. You know this. There are research which suggests that this stock will increase. You invest on those, and then you wait. Others, I told you, dollar cost averaging and buy and hold. These are the basic strategies, but depending on your risk appetite, you need to take a call, and then you invest.
Yes, sir, rightly said. Prafula sir rightly said about this. I wanted to at least just make a very short this thing. See, any person, individual, has to remember, as I said, that 50-30-20 rule. So after that, it should be at least to have a 100 rule. Rule 100. Rule 100 and Rule 110 are actually everybody should remember. A beginner should also have these kind of rules, because they will remember these rules, because there are a lot of strategies are involved. So to actually cover all the strategies is very difficult. So that is the reason, there are rule defines it. So there is rule 100 and rule 110. See, basically, rule 100 is basically gives a percentage of stocks which you hold, by, subtracting your age from 100. So let's say anybody, let's say I am 60 years old, and then 100. So if it is how much to hold the stock, so it should be 40%. So 100 minus 60, so 40% of a portfolio should be in stock, which should be hold in this thing. So that is asset allocation of any individual by age is very also important. So that is also to be remembered, if according to the age. And rule 110 is basically, which is started by the rule 100 itself, which is people are living longer for this 110. It works in the basically in the same way, but when you subtract your age from 110 instead of 100, so let's say if we are 50 years old or 40 years old, then just subtract 110. So if it is 60 years old, which I have put it example, so if, 110 minus 60, so 50% should be hold in the stocks. So depending on the which I say that portfolio should be 40%, even though it's stock or maybe any kind of an investment. So this rules is a guideline to the beginners to make it very clear in the mindset. I'll tell you one thing, that there are a lot of studies, but mindset differs or get the goal defeated because of the situational issues, let's say family issues or maybe some emergency kind of issues. So that flow or discipline would not be maintained. So one should be in discipline and adjust their asset allocation according to age. That is number one. Number three, because Rule 100, Rule 110, and asset allocation by age and discipline is considered. That is time frame should be 5 years. Minimum 5 years should be. You should hold the money into the investment strategy. That is my third point. We should consider the risk tolerance, not the age. See, age is only for asset allocation, right? So, only for asset allocation, but investment stock market basically is one of the asset allocation strategies. So people should get confused between that. I need to make a investment basis on the age. It should be basis on the risk tolerance, which is my opinion says. And we should diversify the holding. Let's say 50%, when we talk about the rule 110, then 50% should be holding of the portfolio for the next 5 years. Then we should diversify these holdings into various categories as per the tax implications, not as per their own conditions. Because at the end, we have to pay the tax, even though if we are salaried or even though we are non-individuals. So we have to make sure that that has to be done. When we hold these, so we have to hold into diversify into each asset classes, like say hold stocks, maybe bonds, or maybe cash. How much cash should be there? Then the rest of maybe we have to diversify into the liquidity part. Then we have to also diversify into insurance part. So these are the 4 5 things which we have to make sure that we have to make our own rules for the asset allocation, depending on the tax implication, depending on the risk tolerance, and depending on the asset allocation of the age. So this is from my side, Vivek sir and Prafula sir. If it is any point wanted to cover
Thank you,
it, sir, that
Santosh.
would be great.
No, actually, I think there are a lot of things that we need to talk about, but we are almost on the cusp of time where we have to close the discussion. And there is another dimension of something called uneven income flows or the seasonal income, which are there for the lot of retailers, the shopkeepers, and the small business people. There is another emerging asset class as the startups. But I think these are the discussions that we are going to hold for maybe another interesting session like this one. And it has been great pleasure to have Viren Parekh sir, Santosh sir, Prafulla sir, Rakesh sir, who have been kind enough to share their valuable knowledge, insight, and too much valuable experience. And there has been a ton of discussion and interesting facts that have been brought forward for by this particular discussion, which was really enthralling for us. So thank you, Biren sir, Santosh sir, Rakesh sir, Prafula sir. It was a pleasure. And on behalf of EPD Academy, I would like to thank you for your valuable time and inputs to make this event a big learning experience for all of us. I would also
Thank
like to
you.
thank my
Yes, sir.
august listeners for their benign presence and making this event a big hit. A very big thank you for the listeners for their kind support and their time. Thank you. Yes, Santosh, you were saying something.
Yes, sir. Thanks. It was a great privilege to meet and greet and get discussion with the experienced industrialist and the bankers, which I could learn. Dr. Prafulla sir, Viren Parekh sir, Vivek sir, Rakesh sir, and Dr. Rajdeep sir. So nice meeting you here, and we'll be continue to connect it. Thanks a lot for inviting me as a speaker.
Thanks,
Thanks a
Mr.
lot.
It
Vivek,
was a
Mr.
pleasure.
Rakesh. this Rakesh, I think a nice opportunity, right, for knowing each other, right? And I think that's a very good platform. Knowing Mr. Viren Parekh, Mr. Santosh, Dr. Prafula since long, knowing you and also Dr. Rajdeep also, right? And it's a really a very
Thank you,
interesting
Rakesh, sir, for your
experience
time
that
and
we
your
had.
input, sir.
Thank,
Thank you,
thank you,
one and
Arvind.
all, and all the listeners here. And we are eagerly waiting for our checks.
Sir, you should be bothered about, award, not the reward. Viren, sir, any last words from your side, sir?
Yeah, I think thanks for making me part of this panel discussion. And I also got a good insight, and thank you all. Only last word I just like to say to all the listeners is that it is not that how much you are earning the money, okay, but it is how you are investing the money that is important. So
Very
remember
true, sir.
this thing.
Very
Yeah,
true.
thank you.
Very true, sir. Thank you. Thank you for the closing comments. Thanks, sir. It's a great insight.
Good night. Good night, everybody. And see
Good
you
night.
in the
Good
next.
night, everyone. Have a great weekend. Thank you.
See
Thank
you.
you for your time. Thank you.